Welcome to another White Coat Investor Real Estate Investing webinar. I'm here with Eric Goodman, a managing partner of Goodman Capital. Eric, thanks for being with us today.
Jim, it's a pleasure to be here this afternoon. Thank you so much for inviting me on this afternoon.
Now, in this presentation, Eric's going to be talking not only about real estate investing in general, but about investing on the debt side of real estate in particular, as well as telling us about Goodman Capital, who's a new sponsor here at White Coat Investor. We're grateful to have him. Thank you so much, Eric, for sponsoring and partnering with us and helping White Coat investors that are interested in adding real estate to their portfolio, maybe to add it in a way they haven't considered before. One of my favorite ways to invest in real estate, which is to invest on the debt side. Typically a little bit less risk, typically a little more of an income focus, but a beautiful, different way to invest, and maybe what people think about when they think about being a landlord. So let's give you some time to introduce yourself. I know you have a slide deck you brought with us, and give you a chance to present those. Afterward, as usual, we'll have a Q&A session. So let's turn the time over to you, Eric.
Looking forward to it, Jim. Again, thanks for having us. And I'm really excited to share a segment of alternatives, the private lending space, which has been part of our family story for the better part of the last 38 years. So with that in mind, I thought just to highlight today's focus, we'll give a quick overview of who we are at Goodman Capital, talk a little bit about the state of the credit market here in the greater Northeast region of the U.S., where is our primary investment market. And then we'll dive into some performance data and look at what we've accomplished over the last 5 to 10 years. So for a quick summary, again, welcoming everyone to Goodman Capital. Again, I'm Eric Goodman, managing partner of Goodman Capital. Goodman Capital is a New York City-based real estate private equity firm established back in 1987, back with the early regulation in the environment with Article 12D of the Banking Act was the early time frame which my parents got into this business. From 1987 through the early part of the GFC, just in the years leading up to it, our management team was one of the early investors in distressed debt, mortgage brokerage, private lending. We covered every aspect of the loan life cycle. And in the post-GFC period, spent a good portion of our time focusing on the principal investment side, pivoting away from the brokerage side to direct balance sheet lending from our family asset base. In 2014, 2015, after 7-8 years on Wall Street, I joined our legacy family business, institutionalized our firm, which we'll talk about in the next few slides, and started syndicating, bringing in outside capital. And today we manage capital on behalf of over 1,000 families, high net worth individuals, family offices, private equity, fund of funds, both retail, institutional allocators nationwide and outside the US. For the last decade, we've closed over $900 million of first lien mortgage financing volume, focusing on the major Northeast market. And I'm really proud to tout our zero principal loss track record over that time frame. Over the next few slides, we'll talk a little bit about how we think about managing risk, which is really at our core, I think, of how we do things a little bit differently than most. Critically, our team brings not just experience on the lending side, but also the distressed debt investing side. And that unique experience managing the downside risk of being in the lending space is what gives us that unique experience and underwriting expertise to now move and grow throughout our lending business. Quick history of our firm. Again, our first financing deal, our first mortgage we closed was in 1987 on 2 multifamily brownstones here in Harlem, New York. We spent the better part of the 80s and the 90s and the 2000s financing, providing first lien mortgage, closing first lien mortgage transactions on Class A multifamily, mixed use, residential housing throughout the greater Northeast. As you can see, through the 2000s and 2010s, as we start to grow and syndicate, we started doing larger transactions. And now, more recently, we're doing much larger 100,000 square foot, 100 to 200 unit multifamily projects all throughout the greater Northeast market. But at our core, we do one thing, and I think we do one thing exceptionally well. We underwrite risk. We finance Class A residential assets across the greater Northeast. These are the same markets we've been financing for 38 years. the same kinds of assets. We know how to own and operate. And that gives us unique perspective when it comes now to financing those same types of properties, playing on the lower risk spectrum, as Jim mentioned earlier, being in the first lien mortgage position. Now, in this business model, it takes a team like anything to do it well. We've built an astounding team of investment and legal professionals who oversee every aspect of the loan investment business. So, starting out with investment management, the team that oversees sourcing of new deals, underwrites new deals, structures loans to mitigate risk. That's overseen by our investment management team, which I co-chair. Our asset management team is chiefly responsible for everything that takes place after we close a loan. Loan servicing, tracking to make sure taxes are paid on the underlying properties, overseeing the workout, the foreclosure when needed, overseeing a successful resolution, taking investor capital from investment through payoff. Then we have a dedicated team for investor reporting, communications, compliance purposes, and of course, most critically in today's day and age, having the right third-party infrastructure. When I institutionalized our legacy family firm in 2014, 2015, I brought in outside auditors, outside SEC counsel, outside fund administration to oversee and ensure providing investor oversight, SEC reporting, audit, and tax. And it's that team today that manages the loan investment business here at Goodman Capital. Here's just a little quick snapshot of the types of collateral that secure our loan portfolios. Again, many may be very comfortable investing in the equity side. Many of you have probably owned, invested, and acquired single-family homes, maybe multifamily complexes. We're investing in those same types of assets, but from a more safer and senior position in the capital structure. And as you can see here, every loan that we're financing is going to be secured by a first lien mortgage on Class A multifamily mixed-use oriented assets throughout the greater Northeast. Fundamentally, I think when meeting with new sponsors, I think it's important to hone in on their investment philosophy. We all take different approaches to investing. At Goodman Capital, first and foremost, we're in the business of managing risk. And so our investment strategy is very much geared towards capital preservation. We focus exclusively on managing our lender basis. Where are we in the capital structure vis-a-vis loan to value, senior mortgage position, always being senior and in the safest part of the cap stack, and always making sure that our borrowers have an intrinsic alignment with us to perform or otherwise face some various punitive penalties for failure to do so. So everything we focus on is very capital preservation focused. We also play in the middle market. It's an area that we deem to be below the radar of the larger institutional allocators. And it's an area where the loan size in which we're giving and the regulatory difficulty of the traditional lenders and banks to compete avails us the opportunity to charge an interest rate premium to our borrowers, which eventually inures to the benefit of our investors. Few other things. Again, as we talk about that, we focus on Class A assets. These are assets that show value, stability, and resiliency across all market cycles. We're very focused on our local Northeast market where we've been lending for 38 years. It's a market we know very well. We're very deeply entrenched in the local relationships that help us source off-market deal flow. And finally, on the last two things, very important when I joined and we institutionalized bringing in outside infrastructure to support our growth over the decades to come. Now, when we talk about lending, and we'll talk in another slide, the private lending space is vast. There are different types of lenders who have different types of strategies. We focus on an area of lending called structured credit, which really goes to the point about what we think about it and how we underwrite our loans. Every loan we give, we originate to a borrower is dealt with a lot of structuring. I'll give you an example of that. If you look at the investment approach, bottom left corner, floating rate and interest rate floors. It's a big concern in today's market. Eric, the interest rate environment is elevated today. That's a really strong benefit for private lending. As interest rates rise, as a lender where you charge floating rate loans, floating rate charge off a certain index, typically the Wall Street Journal Prime or SOFR, secured overnight funding rate. As interest rates rise, we benefit from that rise because we're able to charge our borrower more interest. But the flip side is true also, and this is where structuring comes into play. All of our loans have an interest rate floor. That means that if the respective index, which moves off of the treasury rate, if that index collapsed to zero, we would still be able to generate the same level of return because the interest rate floors in all of our loans are set at the prevailing interest rate at the time we close the loan. That's what avails us the ability to capture upside in an inflationary environment while protecting our returns in a deflationary environment. Speaks to the form of structure, just one element of structure when we're underwriting our loans. Now let's pivot a little bit to understand where we are in the credit cycle. It probably wouldn't surprise too many of you to appreciate that the capital markets are anything but healthy right now. In fact, there's a significant capital markets dislocation, particularly in the conventional lending markets. What we mean by that is the market for bank financing. And that frayedness in the capital markets was born from the inflationary battle and the Federal Reserve's response to combat that inflation, which, with the uptick in rates, the increase in regulatory reform, has led to a significant drop in conventional mortgage origination volume, as you see here on the chart to the right. That's only been exacerbated by the March 2023 banking crisis. We estimate that in the post-March 2023 period, with the fallout of Signature Bank, First Republic Bank, the idling of Flagstar, New York Community, Dime, Sterling, we estimate about a $25 billion funding shortfall that will have to get picked up by the private lending community, the non-bank lending community, which is interesting because in the post-GFC period, we used to call this shadow banking. Had a bit of a negative moniker to it, if you will. And then JP Morgan launched HPS, and other institutional firms launched their multi-billion-dollar funds, and all of a sudden that moniker evolved into private credit. This is one of the largest drivers of new deal volume and pipeline, is the retrenchment and fallout from the March 2023 banking crisis. And we'll look at some real examples of the impact of this fallout. So before we do, and to give it some context, I want to now just pivot a little bit and talk about some of our recent investment vehicles. And we'll talk about how they've capitalized on this new wave of opportunity born from the banking crisis. As I mentioned, everything we do at Goodman is focused on capital preservation and generating monthly passive income. And we'll look at three vehicles here that address such investment strategy. In 2022, we launched our first flagship tax-efficient private mortgage REIT, real estate investment trust, Liquid Credit Strategy Fund 1. And we originated a portfolio of about $269 million of first lien mortgage financing across 21 loan portfolio at a blended 40 to 45 loan to value. Now, for those who may be less familiar with some of the jargon, loan to value represents the ratio of our loan amount relative to the underlying property value. And it's a barometer for risk and credit risk, we call this, and margin of safety. That LTV tells me how much the market value of the underlying property has to drop before we take a dollar of principal impairment. Now, as many of you know from our earlier slides, over $900 million of transaction volume closed with zero principal losses. We're going to talk about in the next few slides how we underwrite risk throughout our various investment vehicles to provide that type of track record that you see here across our most recent funds. LCSF1 closed. We'll be launching the subsequent, the successor tax-efficient mortgage, LCSF2, and we'll talk about what we seek to accomplish in that fund. But juxtaposed to LCSF1 is East End Servicing, which is effectively our cash management vehicle. We launched this fund in 2021. We closed about $149 million of first lien mortgage volume across 22 loans at a blended 45 to 50 LTV. That 50 LTV means that if the market value were to crash in half, we would still be made out whole on our principal investment, because that's the margin of safety we have. Half the property value is represented by our loan. The other half is the borrower equity. So for those who invested in equity deals before, when you invest in equity, you're the first loss position. That means that when the property value drops, you take the hit first. Being in the senior, most safest part of the capital structure, which is where we lend, we take the highest tier of safety, so that first 50% of principal loss is borne solely by the equity, and we're protected and insulated from that market volatility. That's why managing loan to values is at the fulcrum of our investment business. In LCSF2, we'll replicate and do very much what we did in LCSF1. We'll close approximately, we aim to close about a $200 million portfolio at a sub 50 first lien LTV. We'll talk about some of the deals in that pipeline shortly. But before we do, let's just talk a little more in depth about Liquid Credit Strategy Fund 1, also known as LCSF1. LCSF1 was a tax-efficient private mortgage REIT focused on low loan-to-value, first lien senior secured bridge lending. We financed Class A multifamily, mixed-use, residential-oriented assets all across the greater Northeast with a focus on capital safety and tax-advantaged stable monthly cash flow. Every month since inception, for the last 36 months, we hit 100% of our 9% preferred return. Now, this was a dividend yield, which has certain tax benefits we can go into shortly, but it just highlights the safety of our portfolio, which we'll look at in the next slide. We've closed $269 million of first lien volume, over 21 loans with zero borrower defaults, late payments, zero delinquencies, zero foreclosures. We are financing some of the most well-capitalized borrowers on the premier Class A assets in the Northeast. Just to quickly highlight some of these pie charts here, again, LSIV 1's focus was to finance short-term, low-risk, senior secured bridge loans on Class A assets right in our backyard. We financed the entire portfolio to sub-60 LTV. In fact, over 95% of the portfolio was financed at less than a 50% loan-to-value. You can see here a section of how we allocate and how we've been diversified throughout the greater New York area. But principally, I want to talk about one thing, to go into a little bit of depth here on loans by type. We really focus here at Goodman Capital on the nature and use of our loans. Loans can be used for many different purposes. And the nature in which we are giving loans and our borrowers are utilizing our financing is a bellwether for the level of risk in that investment. And I'll give you an example. Over 40% of LCSF1 was allocated to providing acquisition financing. These are loans that were used to finance the purchase of real property. We'll give an example in a few slides of one such case study that was used to provide acquisition financing. And we like this type of financing for two reasons. It provides real price discovery in real time. I can see a real life transaction. I know where that collateral is trading for. That's a far better indicative pricing than just getting a pure appraisal report to value the underlying collateral than to see where someone is paying for a piece of property today. The second thing acquisition financing provides a unique alignment of interest with our borrower. Ultimately, we want our borrower to repay our loan. We are more than equipped to foreclose on that loan and take over the collateral, operate for sale, as we did the first 25 years of our business. But we're underwriting the best quality borrowers in New York. And one way to align incentives with the borrower is to make sure that they have a large equity incentive. How do you make sure they have an equity incentive? By giving them acquisition financing. Because at the closing of a purchase, that borrower is going to come to the table with cash out of pocket. That cash is going to anchor them in the underlying property and is going to incentivize them to perform or otherwise burn up that equity through default interest via foreclosure. That's one of the big drivers of why we like acquisition financing. This is a quick summary of all the loans in the LSIF1 portfolio. I encourage members when they're looking at various debt funds, equity funds, to always ask for what's called the loan tape or the asset tape. It's a simple log of all the investments in the portfolio in which you're investing, and it tells you some very interesting details. It tells you the types of assets that are securing the loan. They tell you the status of the loan. It gives you the loan amount, but principally, it tells you where the fund is with respect to credit risk. And as you can see, we've closed $269 million of first lien mortgage fund volume at a blended 40 to 45 LTV. That includes loans underwritten at as low as 20% loan to value, where 80% of the capital in the transaction is funded by the borrower, up until loans that are 60% loan to value, where 40% of the transaction is funded by the borrower. On average, we play in that sub 50% loan to value space, which is a very conservative, low risk area of the capital stack that provides for a very significant margin of safety if there's market tumult, asset value compression, or any kind of macro shocks that we wouldn't otherwise expect. Let's look at two quick case studies to really get a little more in the weeds here, if you will, of how we think about underwriting. This is a transaction in LCSF1. In March 2024, a borrower came to us with a request for financing their purchase of a $10.5 million penthouse unit at 15 Hudson Yards here in New York. Now, for those who may not be familiar, Hudson Yards is one of the largest infrastructure projects in the U.S. history at over $20 billion, funded by a consortium of various real estate developers and government funding. Our borrower was a wealthy venture capitalist from California who had a term sheet from New York Community Bank just prior to the March 2023 banking crisis. Banking crisis hits. New York Community, which was going to provide a 60% purchase money mortgage for this acquisition, failed. Our borrower was left with 2 weeks to close before otherwise having to forfeit a 10% hard money deposit of over $1 million to the seller, absent their ability to close. We received a call from one of our local relationships who introduced us to the borrower, and within 2 weeks, we were able to close a $5.25 million first lien mortgage. Now, that borrower who had 2 weeks to close or otherwise forfeit their 10% down payment was willing to come to the closing with another $1 million of cash just to close. In fact, at that closing, our borrower had more equity, more cash equity in the deal to close that purchase than we had debt exposure. We've subsequently been refinanced by this borrower when they went and secured a conventional loan refinance with their bank of choice. But oftentimes, we're able to capitalize on these time-sensitive financing needs born from this capital markets dislocation from the banking crisis and secure low loan-to-value, low-risk opportunities for our investors. Let's look at another example. This is a borrower who was a shipping entrepreneur. They launched 4 companies, subsequently took them public. The majority of their assets are overseas. Very wealthy financier here in New York. And in September of 2022 was faced with a dilemma. They had a $14.25 million loan coming due. It was a bank loan, and they had a short time to secure a refinance. Like the preceding example, this borrower needed capital to close quickly. We interviewed the borrower. We understood their financial needs. We learned that they were selling an interest in a ski resort. They were going to come into about $2 million of liquidity. We learned that they had other assets in their portfolio, and we structured a very creative financing transaction that significantly mitigated risk beyond where the low loan to value we otherwise could have structured. Specifically, here we had a property, we had a borrower, had a multifamily asset on the corner of Charles Street in the West Village. For those who watch Sex and the City, this is a few blocks from Carrie Bradshaw's townhouse in the West Village, a very premier neighborhood within New York City. We were able to structure a deal that involved the borrower paying down our loan, the prior loan, from $14.25 million to $12.5 million. They came out of pocket to pay down that loan, injecting more money in the transaction. And in addition, they gave us an additional collateral, a 30-acre single-family residential compound in Millbrook, New York, as additional collateral. We in turn blanketed, or as we say, cross-collateralized our loan across 2 assets, spreading the risk of repayment from one property to 2 properties, and in turn structured an even lower loan to value than we otherwise could have structured had we just given the refinance of the existing loan balance of 14.25. So instead of closing the deal as presented, we restructured the deal utilizing certain elements and structures that we've done historically to financially engineer a 40 to 45% loan to value. This borrower has been current on every single monthly payment since September 22 of approximately $135,000 a month of interest-only monthly payments. Another example of a very well-capitalized borrower who had a time-sensitive maturity, needed capital to close, and we were successful in doing so. That gives you a little summary of LCSF1 and some of the transactions and how we think about underwriting from a risk management perspective. But as we prepare to launch our next fund, we want to give some thought to where we are in the credit cycle and give some context for folks to understand how we're thinking about the future of private lending. In LCSF1, we raised and closed that vehicle from 2022 to 2024 and to early 2025. That was a 3-year fund. Today, as we prepare to launch LCSF2, we're underwriting in a very different interest rate cycle. Specifically, we're underwriting in about a 300 bip or 3% higher interest rate environment. And utilizing that interest rate differential from when we launched LCSF1, we've made some very minor tweaks in the investor waterfall with a profit sharing split between the 2 funds to allow investors to capture even more return and upside in our successor fund offering. So again, LCSF2 will utilize a consistent low loan-to-value income strategy as LCSF1, but with enhanced economics. And so to highlight that, I focused on just the areas of difference between the initial flagship mortgage REIT LCSF1 and our successor fund, which we'll be launching in the coming weeks and months. Again, both funds will be structured as tax-efficient private mortgage REITs, focusing on senior secured bridge lending up to a maximum threshold of 60% loan-to-value. The only fee we charge is a 1.5% fee on equity capital commitments. Every fee we can charge our borrower goes straight into the fund and runs through this waterfall, which is the following. In LCSF1, our waterfall was 100% of first dollars to service the preferred return of 8 or 9%, followed by a full return of capital, and any dollars generated thereafter inure to the benefit of us as the manager. In LCSF1, since inception, we've returned a net 9% dividend yield to Class A and a net 8% dividend yield to Class B. Utilizing the dividend reinvestment and some of the tax saving strategies like the qualified business income tax deduction, investors were able to realize a net return of up to 10.5% for Class A and up to 9.2% for Class B. In LCSF2, we're making one minor tweak that makes a significant change. To capitalize on that 3% higher interest rate environment, we are modifying the waterfall to include, after the 100% preferred return, 100% return of capital, we will then have a 50-50 split between the LP as the investor and the GP as us as the manager of all taxable income thereafter. And that's going to do one very major thing. Because we're in a 3% higher interest rate environment, splitting that return 50-50 increases the return to Class A from 9% to about 10.5%, and from 8% to Class B to approximately 10% for Class B. By utilizing the same tax strategies of qualified business income tax deduction and DRIP dividend reinvestment plans, investors can increase that return from a net 10.5 to 12.2% in Class A, and from a net 10% in Class B to net 11%, 11.7% in Class B. All while focusing in the same senior and most safest part of the cap stack up to a maximum 60% loan to value. Here takes us to LCSF2. Like LCSF1, LCSF2 again is a tax-efficient mortgage REIT focusing on financing senior secured mortgage bridge loans on Class A commercial real estate and residential-oriented assets here in the major Northeast. We're going to target a similar amount of deal flow, approximately $200 million of transaction volume, focusing on a sub-50 LTV. And like LCSF1, we expect to remit monthly dividend distributions equal to 100% of the preferred return. The same return cadence as our predecessor fund is what we expect to do going forward. Now, all of our funds, just to highlight, are IRA suitable. Our vehicles are structured as mortgage REITs, which provide and serve as a UBIT blocker. They block any unrelated business income tax, any UDFI, unrelated debt finance income tax, and the structure converts interest income to dividend income, and that's the pass-through that allows for IRA, solo SEPs, and other qualified capital without any UBIT tax. Again, some of the incremental tax benefits for all of our mortgage REIT vehicles are the 20% qualified business income tax deduction. That's for non-qualified investment. All of our investors are able to utilize our dividend reinvestment plan to compound returns, and for retirement assets are able to utilize our discounted Roth conversion. Let's talk a little bit about the types of deals we're sourcing in LCSF2 by focusing on the first two transactions. These two transactions highlight how we are so squarely focused on risk management. These first two loans represent approximately $90 million pipeline of sub-50% loan to value, senior secured private lending opportunities. Starting with loan number one. Loan number one is a newly built 26-unit residential condo building in the heart of Manhattan. The owner of the property spent $122 million of equity out of pocket to acquire the lot and to build the superstructure. Once the superstructure was complete, the fee owner, the property owner, took on financing of approximately $130 million to complete the exterior and the interior. That lender now called us looking for us to refinance the project and provide a new $75 million senior secured mortgage encumbering the entire building. Our $75 million loan will effectively take seniority over $250 million of capital invested to date, $130 million of which from the junior lender, $122 million of which from the property owner. We will effectively be engineering a 25 to 30% loan to value in one of the Class A newly constructed residential towers here right in the heart of Manhattan at a very attractive, very secure loan to value. Loan number two. This is a transaction we sourced again from our direct borrower relationships. We'll be providing a $14.5 million senior secured bridge loan encumbering 14 newly built townhomes along the waterfront of Dahle, New Jersey. We value the underlying collateral of newly built homes at approximately $30 million. They are listed for sale for in excess of $40. We've applied a very conservative discounted valuation to arrive at a 45 to 50% loan to value. Our borrower, like in the loan number one, is an extraordinarily well-capitalized borrower with a $100 million plus net worth. Another facet we loved about this borrower was their REO schedule. REO stands for Real Estate Owned Schedule. It's a subschedule of their personal financial statement. And it's very important to underwrite the REO schedule because it tells you a few things about your underlying borrower, which is the counterparty. In this case, it tells you that and we learn that our borrower is truly a bankable borrower of $100 million worth of real estate that they own. They have 6 mortgages spread across a portfolio of over 25 assets, all with bank lenders. That's a very attractive real estate owned schedule because it tells me that this is a very bankable borrower, not one that needs to rely on private financing. It tells me it's a borrower that has a great creditworthy track record, that's in need of short-term bridge financing because they have a maturing construction loan coming due and will actually be one of the first non-bank lenders in their real estate portfolio. Again, all about structuring and finding the right alignment of interest with our borrowers. But these 2 deals, I think, are exemplary of how we underwrite risk from the collateral and the borrower perspective. And lastly, just to tie up East End Servicing. East End Servicing is our short-term cash management vehicle that we launched in response to many of our investors who were looking for a vehicle they could utilize to park capital and be able to secure quarterly liquidity. So East End Servicing, again, focused on low LTV, first lien bridge loans on existing Class A residential-oriented assets. The primary difference is that East End Servicing is really there to provide liquidity. It provides 100% liquidity every quarter, and it's an idyllic vehicle for those looking to park capital earmarked for some of our other fund offerings in anticipation of their launch. It's also a great vehicle for those looking to park capital for short-term investment, either ahead of a tax bill coming due next year, excess liquidity in their portfolio, or again, capital they're looking to earmark for subsequent offerings of ours. East End, like its predecessors, closed about $149 million of first lien mortgage volume across 22 loans with 0 borrower defaults, 0 late payments, 0 delinquencies, and 0 foreclosures. We closed this portfolio about a 45-50 LTV. We've been remitting 100% of our preferred return of 8% paid monthly for the last 48 consecutive months since inception of East End Servicing. Like predecessor funds, again, I always highlight the loan tape to get a real flavor and comfort of the assets in the existing portfolio in which investors are participating. And like our predecessor funds, here too, we underwrite loans from as low as 20% loan to value up until 60-65% loan to value at the high end, blending out to about a 45 to 50% loan to value in aggregate. Just to wrap up, one of our last slides here is just a quick side-by-side highlighting LCSF1, our predecessor income flagship mortgage REIT. LCSF1 again paid an 8 or 9% div yield, which was able to be enhanced up to 10.592, depending on utilizing our dividend reinvestment and QBI deductions. We remitted monthly distributions since inception. LCSF1, like LCSF2, is a closed-end fund. It has a 3 to 4 year fund life. Years 1 to 2 are full investment periods. Year 3 to 4 are wind-down periods. These are idyllic periods of time to utilize the discount Roth conversion, dividend reinvestment, and reap the benefits of the QBI tax deduction. With LC1 closed and wind down, we have East End Servicing available for short-term investment, primarily for those looking to roll over into LCSF2, which will be our second flagship private mortgage REIT, which, as we talked about, will have an 8% or 9% div yield, a total div yield of 10.5, inclusive of the 50% split, which, if utilizing our dividend reinvestment and tax savings, will inure up to 12.2% for Class A, 11.7% for Class B. Like all of our vehicles, will be remitted on a monthly basis. And like LCSF1, will have a 3 to 4 year fund life. Like prior funds, same tax benefits, same ability to utilize DRIP, discounted Roth conversions, and discounted tax savings, which will be launching our first round next month, and we'll be raising capital over the next 2 years, deploying capital over that same 2-year window with a wind down throughout years 3 to years 4. All of our fund vehicles to date have been closed-end funds, which means that we raise capital over a finite period of time, typically 18 to 24 months. Over that 18 to 24 month period, we are deploying capital. Every month from investment through wind down, we are remitting our monthly dividend distributions. And from years 3 to years 4, as our loans pay off, all of our loans have typically 12 to 24 month loan terms. As those loans pay off, we return principal, wind down the fund, and launch LCSF3, and so on. So just as a last slide for next steps, again, just highlighting some key offering dates. East End Servicing is available for investment every month. It's available for liquidity, for redemptions every quarter. And that's the ideal vehicle to park capital in anticipation of subsequent fund offerings, the first of which will be LCSF2 launching its first round next month. Immediately thereafter, we'll be remitting our first dividend distribution to those who participate in the first round. Those distributions will continue every month thereafter until the wind down of LCSF2. And again, by December and for the next 2 years, we expect to launch subsequent fund offerings of LCSF2 and remit monthly dividend distributions immediately thereafter. Just a few highlights of Goodman Capital recently in the news, recent deals that we've closed on. But for those who would like to learn more about Goodman Capital, participate in our upcoming fund offerings, I would encourage everyone to reach out to us at invest@goodmancapitallllc.com, or feel free to schedule a call with us on Calendly at calendly.com/Eric-Goodman.
Thank you, Eric, for doing such a comprehensive job. We've covered a lot. So I'm going to slow us down a little bit here. They can see the contact information there for you. And I just wanted to talk about some general questions, then some specific questions. Let's start with just a general discussion about the pluses and minuses and definitions of investing in performing versus distressed debt. Can you talk a little bit about that to start with, as well as what you expect these funds to be investing in?
Sure. So the loan life cycle is comprised of two legs. There's the performing leg and the distressed leg. Like every loan starts at origination. Some lender, a bank, a private lender, a life insurance company originates a loan. That loan, depending on the loan term, will come due at some finite period of time. And over that period of time, if the borrower fails to remit a monthly borrower interest payment, breach other loan covenants, fail to repay the loan when it comes due at maturity, that loan resets or triggers an event of default. And from the event of default to the final resolution, which is the payoff of that loan, that leg of the life cycle defines the distressed debt leg of that life cycle. That second leg is where we spent the first 25 years of our family business, rolling up our sleeves, executing foreclosures, workouts, bankruptcies, appeals. That's where we cut our teeth. And it's that knowledge base and experience for over 25 years that informs the way we underwrite loans today to manage that risk of a borrower default, and how you manage credit risk and manage principal risk. All of that is informed by over 25 years of getting in the weeds of managing distress. There are different return profiles of a distressed debt investment versus a performing loan investment, but fundamentally, what drives one attractiveness over the other really comes down to loan to value. And in years past, in the 80s, the 90s, these were much more nascent markets for distressed debt. What I mean by that is banks were scared to hold loans in their books that where a borrower was non-paying for 30, 60, 90 days. Once the bank has to hold a loan for over 90 days past due, we call it, the borrower's been delinquent for more than 90 days, banks were obligated to hold loan loss reserves. And those loan loss reserves take away bank ability to lend out their deposits. And that's the nature of the bank business, is a loan deposit ratio. They take in cheap deposits, lend out expensive loans. If banks cannot lend out loans because of the regulatory reform, they sell those loans and move them off their books. Today, banks have a lot less inventory to sell. Banks are originating a lot less, so there's less inventory to sell. And especially in the wake of the March banking crisis, with the broader retrenchment and fallout of these banks, there's no one supplying capital. Borrowers still need financing. Transactions are still taking place, but they're not being facilitated by the conventional bank lenders. They're being facilitated by the alternative private lenders.
Now, as I look at the geographic location of the properties on most of these loans, it's New York, right? A little bit in New Jersey, it looked like a little bit in California. New York real estate's unique. Tell us what you like about it, what we should be excited about doing business in New York. Should this be sought out or something to avoid? Tell us a little bit about that aspect of the funds.
Absolutely. So I will tell you that the largest institutional investors who have operations in New York have dedicated teams in New York and only do New York, because as you correctly pointed out, Jim, New York is a microcosm unto its own. It's a very high barrier entry market. Asset values are expensive. There's a lot of in the weeds. New York is a judicial state, which means that in order to execute a foreclosure action, these can be 18, 24-month processes at the quickest. And this is what exactly the business plan that our in-house team of legal professionals know how to execute, but they can take a lot longer with inferior quality legal counsel. And so we love the fact that these are high barrier entry markets because it keeps out a lot of competition. These are also the same markets that we've been lending in and investing in for over 38 years. As a family business, we own over 300 apartments in the New York area. So we are keenly attuned to understanding how to operate residential-oriented assets if and when there's an opportunity and that requires us to foreclose and take over that property, renovate, lease up, sell, and reclaim and take back our principal investment. So I would say that New York is a microcosm unto its own. It really is only fit for specific lenders who have real local market knowledge, real local experience, decades of experience lending in the New York market. And if you're investing with that kind of sponsor, New York is unrivaled, because on the flip side, if you understand New York, you have the relationships. New York is one of the most resilient, deepest, richest transaction markets in the country, if not the world. What I mean by that is when markets are frayed and assets aren't trading out in secondary markets, there is depth of book. Buyers love New York because at every price point of an asset, specifically in the multifamily housing asset class, there is a buyer. Assets don't just fall out of bed 40% overnight. In fact, we did a number of analyses looking even at office properties pre and post COVID, pre and post work from home. And even there, you see volatility of 20, 25% versus 70, 80% in some of the more burgeoning markets nationwide. Again, we focus on the residential oriented housing sector. That's the housing sector that has less than 2% vacancy. Even in what I would argue not the best mayoral office of the last 8 years, we have seen rents continue to make new highs and set new highs throughout the greater New York area. New York is over $4,500 per month, just your average one-bedroom rental. That resiliency is here, and it's reflective over a history. There's a provenance, if you will, or a history of maintaining these elevated levels when other markets are struggling throughout the country. We're on a finite island in Manhattan, even Brooklyn and Queens, high barrier to entry market. We don't have endless space to develop, and that supports price stability. And one of the most critical things when you're underwriting and being as a lender, you need to have asset value stability. It's the only surefire way to ensure that your loans are adequately secured and you're protecting investor principal.
Now, you've been managing partner there for a decade. What's changed in the firm in the last 10 years?
I'll tell you. So this is a business at the fundamental level that my parents started in 1987. And so the underwriting prowess, the way we think about managing risk, having years of experience of structuring different types of loan profiles. I think today more than ever in the last decade, it's been so exciting to now be leading Goodman Capital into this next chapter, because we have over 25 plus years of history to pull from examples, case studies, loan structurings. We are applying institutional loan structuring tools to manage risk to the mom and pop middle market segment. And now more than ever has that middle market segment been left to dry by the conventional lenders of the country. We had a huge, massive banking fallout. There are very few limited options to secure conventional bank financing for almost any type of asset, cash flowing or otherwise. So to be able to have now the tools and the experience to be in this industry, but now to apply it on an ever-growing opportunity set is such an exciting time right now at Goodman Capital.
You mentioned a few factors that are certainly affecting the private credit landscape. I mean, interest rates have changed, right? 2022 is rapidest change we've ever had in interest rates in such a short time period. 4% over a matter of just a few months. You also mentioned the change in kind of banks and what they're willing to put on their asset sheets. What else is driving the landscape for private credit?
I'll tell you, there is a new wave of market entrance in the private credit space that is actually surprisingly, even though it's added more competition, it's actually widened the gap between expectations of borrowers from bank rates to private lending rates. There have been a number of new market entrants that are trying to capitalize on this elevated interest rate environment. And that's a good and bad thing. It's a great thing because more lenders that have entered the market to try and seize the opportunity of the higher interest rates are lending at higher octane, higher up loan to values, trying to maximize returns, trying to hit 14, 15% plus returns. And that's been a big portion of the private lending landscape here in the major Northeast. And what that's done on the flip side is it's given us a very unique window to enter and price loans from an interest rate perspective between what borrowers would expect on the bank side to what the prevailing interest rate is for the average private lender. Whereas your average private lender will be 14, 15%. Most banks are going to size up their loans, whatever loans they are going to close today, be it SBA or otherwise, in the prime plus 1.5, so it puts you on an 8.5 to 9%. That leaves a nice vacuum or landing strip for Goodman Capital to step in and originate loans at a 10 to 11%, maintaining about a 200 bip, 2 to 3% spread from our nearest competitors, while still charging a slight rate premium to banks. So competition isn't always bad, especially when it coagulates at bookends of the spectrum. It creates a great runway of opportunities for those who seize it and know how to structure debt. So I'd say that the competition has been a really fascinating part to see, but competition but only benefiting our business practice and the way we underwrite our loan portfolio.
Yeah. Now, risk control is the key aspect of investing, not chasing returns, of course. And those who are interested in investing on the debt side of real estate have usually learned that lesson. So let's talk a little bit about the real risk your investors are facing. What would have to happen that these funds could blow up enough that people would not only not earn a return, but actually lose some or all of their principal?
So let's think about that conceptually for a second. If we have the traditional capital structure, we have the mortgage holder at the top of the capital structure, the senior safest part of the cap stack capital structure. And for those who may not be familiar, a capital structure is the fancy financial jargon for a tiered stakeholders, owners and stakeholders of a particular asset. Again, every asset has a capital structure. Not every asset has debt financing, obviously. But a piece of property will have a capital structure involving the senior secured mortgage holder at the top, junior or subordinate financing just below them, and as you move lower and lower in the capital structure down towards preferred equity and finally common equity. In order for investors to lose principal investing in a loan investment, that means that the equity tier of the capital structure has to be wiped out. So we have to have asset value compression. We need to have the asset values drop enough to wipe out the equity. Then, if you have a junior lien holder, we need to have asset values continue to drop to wipe them out. And finally, in the senior most part of the cap stack, then you have the senior debt holder, which is the last stakeholder to lose principal because everyone else has absorbed that shock first. Now, commensurately, it's also going to ostensibly earn the lowest level of return, which again could be 9, 10, 11%. And you would hope the equity would earn a 20+% return. So on an average, if you have 50% loan to value, you would need asset values to drop 50%, and you still would not lose principal. But invariably, if the borrower defaults and creates other issues and legal costs, you could ostensibly see yourself having some principal impairment, but you have to see the property values drop. Now, it's actually more than that because as a lender, we require all of our borrowers to pay us monthly interest. Many times, we also require the borrower fund what's called a static interest reserve, which just for simple jargon is like a security deposit. So while we may give a loan for $10 million, very seldomly are we actually exposed the full $10 million. We may retain $500,000 just as a buffer. The borrower cannot tap into that. They cannot use it to pay interest. It is simply there as a buffer that will then get credited back to the borrower. And then as the borrower remits monthly interest payments, those payments are reducing our risk exposure. So every month our borrower is making payments, our risk is getting smaller and smaller and smaller. In fact, in some of our loans, we cut our loan exposure by over half just over the 2-year loan term because of borrower interest payments. You can see the way we think about structuring. We are really focusing on capital safety. Now, I'll take one step further. Not only would property values have to compress and compress so much so that the equity gets wiped out, but also compress that all the income that you've generated over the loan term is still insufficient, we then have other remedies. We can go after the borrower because all of our loans are recourse loans, which means we can go after the underlying owner of that property for any shortfall. As you can see, Jim, we have a fully mapped out foolproof plan of every step of the way. This is really a jigsaw puzzle lending business. But what I like about the lending business, unlike the equity business, where surprises hit you only after the investor has already contributed capital and invested with you, in the debt space, you can check every landmine before you raise $1 of investor capital. You can secure yourself into a position to withstand any principal shock and not lose principal before you raise investor capital. And that's very powerful because there are very few other areas within alternatives that give you that level of capital protection.
Yeah. Let's talk a little bit about taxes now. Are your investors going to have to file a New York State or New York City tax return?
It's a great question, Jim. All of our lending vehicles are treated, especially now as our mortgage REITs, they only generate federal K1 or 1099 div income. The income that we generate is considered portfolio income. It is not. There's no source form of income, so the IRS does not treat this business as a New York State or city sourced income. So there is no New York City, no New York State tax filings. It is either going to be a federal K1 income or a 1099 div, which will have no New York City or state tax withholdings, be a straight 1099 div income with the added benefit of that qualified business income tax deduction, which we could certainly talk about if you'd like.
Sure. Well, you mentioned LCSF 1. You described it as tax efficient, which is not a word I typically hear used when we're talking about investing on the debt side, right? That's usually one of the downsides of investing on the debt side is it's not as tax efficient. You don't have depreciation covering your real estate income. So tell us about what you mean when you say it's tax efficient.
Jim, to your point, pre 2017, lending was probably the most tax inefficient way to invest in alternatives because interest income was taxed at your ordinary income bracket. Passage of the 2017 Tax Cuts and Jobs Act fundamentally changed that. And what the TCJA did was it expanded the definition of qualified business income to include qualified dividends, qualified mortgage REIT dividends. That was the analog to depreciation for equity investing. And what effectively availed now for the first time was investors in debt instruments to be able to take a 20% tax offset from their first dollars of income. That was intended to sunset throughout 2025 before the passage of the One Big Beautiful Bill in July of 2025 that made those tax savings permanent. So when you invest using non-retirement after-tax assets in a mortgage REIT, be it LCSF1 or LCSF2, at year end, you're going to receive a 1099 div. And on that 1099 div is going to itemize those dividends under what's called the Section 199A dividend, which relates back to the Tax Cuts and Jobs Act, that are eligible for that 20% tax savings. And so, in effect, for the first time in quite some time, it is now very tax efficient to invest in one of the safest forms of alternatives, private mortgage lending.
Okay. So you're getting the QBI deduction, this 199A deduction on it, but otherwise it's still ordinary income and you're getting interest paid out. It sounds like, is that being paid to the investors monthly or quarterly, or how often are the investors actually getting income paid to them?
The investors will receive distributions monthly. So in
Monthly.
all of our
Okay.
predecessor vehicles, LCSF1 the last 36 months since launch, East End the last 48 months since launch, our borrowers remit to us monthly, and we then turn that around and remit to our investors monthly as well.
Yeah. Okay. Now, when you were designing these funds, you had to make a decision on whether these were going to be closed end funds or open ended funds. How come you decided to go the closed end route, and what advantages do you see to you running the funds as well as the investors from that structure?
So, Jim, it's a great question because it is a structure that we toy with going back and forth. Many times, growth oriented investments are structured through closed end funds. And in more recent times, we've seen more income funds be structured through evergreen or open ended funds. I'll tell you, the closed end fund, in my opinion, for certain types of vehicles and certain types of investments, has certain unique advantages. One of them is purely just valuation. In the open-ended fund, one of the ways to value shares is through this concept called net asset value, NAV, which is very much a manager-influenced concept. And it needs to be very dutifully underwritten and managed to make sure that it's being properly reflected based on the portfolio value. In a closed-end fund, our accounting methodology follows a traditional capital account statement. Amount of capital invested plus income, less distributions, plus commitments, less redemptions is the ending value. It's a very clean, very transparent form of accounting. Second reason, and probably I'd say even more the first reason why we like closed-end structures, it actually protects the investor, and I'll tell you how. In an open-ended fund, ostensibly, it's open for investment at any time. But we all know that when you invest in alternatives, there are not always opportunities available anytime. And so with a closed-end fund, we were able to strategically and thoughtfully raise capital only when there is a defined investment that we feel merits our capital and those of our investors. And so we can align capital more strategically, investor capital and ours, with the opportunity set. So we can raise capital over 7, 10 rounds. Each round will typically correspond to a particular deal that we have identified fits our underwriting criteria. We'll close the round, and then as we do subsequent rounds, everyone is an investor, a pro investor there too. So I do find that historically, given the nature of our opportunity set, that a closed-end fund is a very idyllic structure to mitigate yield drag. It doesn't force us as a sponsor to deploy capital we otherwise don't have an opportunity for, and in turn ensures that we're allocating the way investors are looking for us to allocate thoughtfully, strategically, while mitigating yield drag so we can continue to deliver those returns every month.
Okay. I want to spend a little bit of time going back over some of the terms for the fund. You covered these, briefly, but I just want to make sure we're emphasizing each of these. Now, the minimum investment for white coat investors to get Class A status is what exactly?
So our minimums right now in our offering documents are $500,000 for Class A and $100,000 minimum for Class B. Like all of our investment groups, and Jim, I'm sure we'll have a follow-on conversation. As a grateful member to be part of White Coat, I'd be pleased to offer White Coat some preferred returns for those investments by adjusting those thresholds, which I'd be happy to talk with you.
Okay. And how long exactly will capital be tied up? We committed, this month to invest money. How long until all of our capital you anticipate will be returned?
From the first offering round to the final liquidation is about a 3 to 4 year window. So just to kind of highlight the three periods of that, there's the offering period, which is a period over which we're raising capital. It's approximately 18 to 24 months. There's the investment period, which overlaps that offering period. It's the period of which we can deploy the capital then being raised. And then once the loan is beyond or pays off beyond the cutoff of the investment period, the return of that capital has to be distributed to investors, which hastens the wind down of the LCSF2 portfolio, the same way it did LCSF1. So LCSF1, we launched in June 2022, will be fully wound down by the end of this year, 3.5 years. And I expect a similar 3 to 4 year cadence from start to finish for LCSF2 over that period, every month receiving monthly dividend distributions.
Okay. But the capital is not coming back all at once. It's coming back in drips and drabs over a period of a year, year and a half, something like that.
Correct. So and our average loan term is 12 to 24 months, depending on the nature of the term, sometimes 12 or 18 months. So depending on when we originate that given loan, between years 3 to 4, you'll see it come back in tranches as prior loans are coming due. So effectively, the earliest originated loans are the first to pay back. The later originated loans are the last to pay back. But to your point, they come down in dribs and drabs. And as the principal is returned, investors will continue to earn that net 10 or 10.5% dividend yield on the unreturned portion of capital.
Okay. How much leverage does the fund use?
So historically, leverage was only ever used for balance sheet management. What I mean by that is we would use leverage. Let's say there was a delayed capital call, and someone, we do with a closed-end fund, you call capital for a given round. Someone said, I committed a certain dollar. They needed an extra 2 days to fund, but I had to close the subsequent day. We would then utilize our leverage line just to plug that gap and backfill. So in LCSF1, negligible leverage because it was used as a balance sheet tool, and I expect a similar use of leverage in LCSF2, barring one specific scenario. And that's the scenario in which the Federal Reserve does something completely unprecedented and cuts rates just as aggressively as they rose rates starting in Q1 and Q2 of 2022. Because when we, as I mentioned earlier, when we set our loan parameters and we close a loan, we are setting that interest rate, the floor rate, at the prevailing rate at closing, and with the optionality of capturing any upside if rates increase. But if in 24 months, the very tail end of LCSF2, if something completely unprecedented happens and rates drop precipitously, it's going to be hard to hit a net 10.5% dividend yield if the prime index drops from 7.25% to 0%, for example. And so in that one instance, depending on the opportunity set, we may need to use some leverage. Now our leverage rates are going to be capped. They're going to be capped at no more than 50% of the collateral value. But given the loans that have already been signed up in LCSF2, this would distill down to a max leverage of anywhere from a 0.1 turns to a quarter turn of leverage, which is just the amount of leverage that could be fully paid off within 1 year of income.
Now, how many of the loans in the fund are anticipated to be in first lien position?
So historically, Jim, all of our loans are always first lien position. We don't do subordinate financing. We don't do junior liens. We don't do pref equity. It's only senior secured mortgage financing, maximum 60% loan to value.
Now, I also said I saw you list Class A property. Do you only lend on Class A property? And if so, how come you chose to do that?
So I'll tell you, the nature of the opportunity set today is actually a fewfold. But one of the largest portions of opportunity today is newly built residential housing. The reason for that is actually quite interesting. Any new construction, because of the labyrinth of constructing in New York City, which, as you imagine, the political fair will take multiple years to build. You're building 50,000, 100,000 square foot multifamily. This is not getting built in 12 months. And so a lot of new construction that's coming online today was built in the immediate post-COVID period. and was likely impaired by the construction and broader moratoriums imposed by New York State. That's a very interesting asset class because those loans that were delayed or those projects that were delayed were funded with construction debt that has, unfortunately, to the detriment of the property owner, has risen in costs up to 400 or 500 bips. Those are the exact kind of borrowers that today are looking for lower cost financing. And those are the exact kind of borrowers say that we're finding that are courting our capital. They don't want to be paying the 14, 15% interest. They unfortunately are unable to tap into the conventional lending markets either because of time, complexity. Banks do not like financing build for sale product. They only like rentals. That's a forgotten asset class, yet also one of the safest asset classes to be financing for one prime reason. If the construction lender gave a loan at a certain loan amount and you were comfortable with that loan to value, if they gave that loan on a vacant piece of land and today that asset is built, if you give the same loan amount to that borrower secured by the same collateral, you're effectively taking the same dollar risk as the construction lender without any of the construction risk. So on par, you're at a higher risk adjusted return than that preceding lender. That applies to whether that preceding lender was a bank lender or private lender. So we're seeing a lot of new construction that is looking for a cheaper takeout. That's a very safe asset class because it's new construction, it's more resilient, it has a lower tax base. Buyers in today are looking for turnkey product. New York, as you might imagine, is a very wealth concentrated market in the country. And we're finding that product, when we finance it, tends to sell very quickly. It's also very resilient. Now, that's not to say we won't also finance renovation. We're very geared on capital preservation and managing risk. So there's three ways to manage risk. The collateral. We do prefer Class A collateral, but we will finance, Class A minus, Class B plus collateral. But the biggest portion of opportunity we're finding is in the Class A asset space. But the second way to manage risk is the borrower profile. If you have a well-capitalized borrower with deep liquidity, a very high concentrated bank-oriented or credit grade lending profile, if you looked in that second deal, that's a very strong borrower that has a high likelihood of repaying you. They're incentivized, they're aligned to repay. And then finally, we look at structure. We're always the first lien position, but many times we will bring in additional collateral to secure a loan. We may bring in other lenders to step in the junior piece. And that junior lender will now be a new counterparty to act as a buffer if values compress. So we're always thinking about the collateral, the borrower, the structure, and taken together in three, those are the three pillars of credit underwriting. If you manage those three correctly, that's how you create a portfolio with a zero principal loss track record as we have.
Yeah. Now, this is New York City. So these are big loans. You're talking about 150, 200, $300 million fund, and only perhaps 22 loans in that fund. Some of the examples you showed were 6 to 13 million, but you also mentioned a $75 million loan, which is a pretty good chunk of a $150 million fund. Can you talk about the typical range and the size of those loans and what kind of diversification people are going to have between various loans in the fund?
Absolutely. This question actually, even if I can draw, harkens back to a question you asked earlier with what has changed here at Goodman Capital. And I'll tell you, the fundamental strategy hasn't changed, but the neighborhoods in which we're lending have gotten much stronger, much deeper, richer. Borrowers are coming and developing great quality assets. And we're part of that transformation of New York. Now, as a result, deals that we would have done in the 80s and 90s, under $2 million, you could have gotten a lot more for $2 million financing. You could have financed a whole city block in certain areas of New York. Today, $2 million wouldn't finance, in some units, they'd be 5% of the purchase price of some of the residential assets that today we're financing. That doesn't mean that we have given any less consideration or thought to risk mitigation, not from a credit side, but from a fund management side. So all of our funds have certain concentration risk thresholds that we have to maintain. All of our funds preclude us from allocating any more than 20% of the fund to any one transaction. So we may get a $75 million deal, but that full 75 is not going to go into the fund. In that particular transaction, for example, we've already syndicated out the first 55 million across our family office community, and the balance 20 million will go into the fund. Many of the investors in the syndicate portion will also be invested in the fund, but we do have these creative structures for those who are looking to get extra exposure to certain particular assets they like the credit risk profile for, but also deals where we need to maintain those concentration limits will also syndicate out. But at the core fundamental, that deal is no different than a deal from a $1 to $50 million loan insofar as LTV, credit risk protection, junior lenders acting as additional buffers to absorb price shocks. So the way we think about underwriting is going to be consistent throughout any transaction, but the size is going to, of course, be a function, and how much we do in the fund is going to be a function of how we manage risk on the fund level side.
Yeah. Now you mentioned quite a few of the loans you're making are variable rate loans with some minimums, et cetera, on them. How much of the loans that the funds will make are going to be fixed versus variable, and what protections are there both for the fund with the variableness of those loans, as well as what effects may this have on the borrower in being able to actually pay the interest due on the funds as far as risk control goes from using these variable loans?
So, Jim, I'll tell you, the last fixed interest rate loan we gave was in June of 2022. We learned our lesson by not capping the upside, but in the years preceding that, there was really no delta between charging borrowers a floating versus fixed interest rate loan. We learned as when you have unexpected price shocks or movements in the Fed that we have to adapt. And so after that last fixed interest rate loan that we originated in June 22, every loan thereafter has been a floating rate with a fixed interest rate floor set at the rate at closing. Now you ask a very good question, which is what impact does that have to borrowers? Well, all of our borrowers are obligated to pay that minimum interest rate, or otherwise suffer being in default. They'll face penalties for that. And we have had zero borrower defaults or missed payments, as much as we might otherwise like them to, because they would be very attractive distressed debt opportunities for the other segment of our business. We obviously can't put borrowers in default, but borrowers are able to pay us off early. And so having a high interest rate, even a high interest rate floor, does create, in certain environments, repayment risk. Because while the Champerty Act precludes us from forcing a borrower to stay encumbered or stay in default, they have every right to prepay. Now, our risk mitigant for that scenario is what we call yield maintenance or prepayment penalty. And what I mean by that is, in all of our loans, we will charge borrowers a certain amount of interest over a finite period of time that they will be obligated to pay us if, let's say, they want to pay us off 24 hours after closing. Typically, on a 12-month loan, we will require a 50% or 6-month minimum interest period. So that way, if the borrower pays off in month 3, they're still going to owe us 3 months of interest as if they didn't pay off our loan. Now, that 3 months of interest gives us a very important buffer, because if we do see a precipitously declining interest rate environment, we're going to want to know we have protection to keep servicing our investors. That extra 3 months, 6 months, 9 months is what allows us to continue to service our monthly preferred return to our investors, even if the borrower pays off our loan. Now, that time is very critical. It's a bit of an hourglass, because we have to ensure that we're finding new opportunities that meet our stringent underwriting criteria. And to the extent we don't, we'll return the principal. But to the extent we do, as we're being inundated now with opportunities born from the banking crisis and so forth, that interest is just an added yield to investors and creates the opportunity to out-earn above a 10.5% div yield. Because that same loan that pays the same 10.5% div yield, if you add another 3 months of interest without actually being invested because the borrower's paid off, that interest goes right to the waterfall, and now will enhance returns above 10F. We could see 11% plus on a net dividend basis without any tax savings, any DRIP, or discounted Roth conversions. So that's a crucial way that we and very few others are mitigating that risk of an interest rate decline. But something that we think about in its entirety, because that is a possible scenario in the next 24 months.
Now, how many loans do you expect to have in each of the 2 open funds at any given time?
On average, we'll see anywhere around 20 to 25 loans. An average loan size, as you mentioned, could be anywhere from, I'd say 10 to 20 million is the average size, with some loans extending, as low as, 5 million plus or minus, going up to, this is a one-off at 75 million, but I would say up to about 50 million is the average range of opportunities that we would see, and diversified across 20 loans, 2025.
Now, you mentioned that these funds are relatively IRA friendly. Are the funds going to be on like the Fidelity platform for people that have self-directed 401ks? What issues have people had with those, if any?
So all of our funds have been on multiple platforms. LCSF1 was available on the Fidelity platform, on the Charles Schwab platform, dozens of other custodial platforms that we work with, Directed, Spira, New Millennium, Mainstar. So we're on a range of platforms. They typically take anywhere from 8 to 12 weeks, depending on the platform, thinking now more specifically to Fidelity and Schwab. But once we are on the platform, at that juncture, an investor could invest directly through Fidelity or Schwab. There's no difference in terms, other than just seeing all that investors' investments on one consolidated dashboard. Investors also have the opportunity, if we're not on Fidelity or Schwab right away at the immediate launch of the fund, they could utilize another custodian and then transfer to Fidelity and Schwab once we've been onboarded. And then once we've been onboarded, again, 8 to 12-week process, they can turn on DRIP and start reinvesting monthly dividends.
Now, let's talk about the drip feature. Exactly how does that work in a closed-end fund? Let's say we're 2.5 years into it. You're starting to return principal. I'm interested in just reinvesting everything. How does the drip work at that point?
So that was the founding inquiry, Jim, that led to the modification of the East End servicing offering. Because to your point, in a closed-end fund, ostensibly one can only reinvest dividends during the offering period. But after that 25-month cliff, the fund is no longer open for new investment. And we, listening to our investor base and trying to come up with a solution, realized that East End servicing could be that consummate vehicle to provide liquidity. And so for the first 24 months, investors will be able to utilize DRIP, dividend reinvestment plan, right into LCSF2 to compound returns. After that 24-month period, we're looking at a 1 to 2 year wind down. Over that 1 to 2 year wind down, East End servicing will be available for monthly reinvestment of dividend reinvestments from LCSF2. Those will grow in East End. Investors can utilize DRIP in East End servicing as well and keep reinvesting. So effectively, East End operates as a quasi open street, open vehicle, and having a longer offering period. And then once LCSF2 is fully wound down, investors can utilize East End and roll it directly into LCSF3. And that's been the cadence from LCSF1 to LCSF2. Folks reinvest in LCSF1, investment period closed on the 24-month cliff. Folks use East End servicing grew. Now that LCSF2 will be opening, everyone will be rolling from East End back into LCSF2. And again, East End has available liquidity for redemptions every quarter. So folks were also able to use East End not only to compound DRIP from the flagship mortgage REIT LCSF1 and soon to be LCSF2. East End can also house capital for extra liquidity in one's account, because once you're above the minimum threshold of 100,000, there is no minimum above that, which is somewhat unique, as many sponsors will require minimum increments of 100,000. Once investors are beyond that 100,000, they can reinvest $1,000 into East End servicing, and they can use it to park excess liquidity in their various accounts, which can either be redeemed at a later date or rolled over automatically into LCSF2 and then LCSF3 thereon.
Okay. Tell us a little bit about the discounted Roth conversion feature.
Discounted Roth, a favorite subject matter of mine. So the discounted Roth is a very interesting feature because I trust that many in white coat are beyond the income threshold, thankfully, of making direct Roth contributions. So one of the few ways sanctioned by the IRS to contribute to a Roth is the conversion from a traditional IRA to a Roth IRA, or a traditional 401k to a Roth. And that conversion can happen without any discounting, as it does for many clients. But I do encourage clients to really consider the benefits of a discounted Roth. And here's how that works. When you invest in stocks, for example, stocks are one of the most inefficient ways to utilize investment for conversion, because stocks are marketable. You can sell them in the open exchange. And while you do have a minority control, you get a much smaller discount for investing in stocks, and because of the plethora amount of liquidity the public equity markets avail you. When you invest your traditional IRA, self-directed IRA, into a private placement that meets a certain number of criteria, two of the most important criteria being lack of marketability and minority control discount, you can convert that value from a traditional to a Roth, and you're converting the value of your investment, not the cash in your pension account, but the value of those LLC shares. You can convert to about a 40 to 50% discount. If I can, let me just give a little high-level context for what it means, marketability and minority control. Marketability is the inability to sell or transfer one's interest absent approval from the manager. Because we're a closed-end fund, unlike an open-ended fund, investors don't have the right to exit at any time. And they also require GP consent. That consent is what gives rise to the marketability discount, which can be 20 to 30% of value. The second mode of discount is minority control discount. One of the rules to qualify for REIT eligibility, and there are many rules we have to qualify, that's why we have two outside auditors auditing all of our vehicles, is what's called the closely held shareholder test, and which stipulates that no fewer than 5 members can own more than half the REIT. This was a piece of legislation that came out in the 50s, one of the Tobacco Acts, that was effectively the government saying we don't want a bunch of wealthy boys and girls to get together and not pay Uncle Sam. They wanted REITs were intended to be forms to democratize property ownership outside one's primary residence. And so one of the rules to qualify for REIT eligibility and get the QBI tax deduction is that you have to maintain a certain number of corporate shareholders, and you need to make sure that you're not compromising concentration risk. So by default, anyone investing with us will always de facto be a minority owner. And that minority owner can earn a 20 to 30% discount. So taken together, depending on the CPA, specialized CPA firm used, and we work with many from our clients over the years, investors can convert from a traditional to a Roth at a 40 to 50% discount. At the time of conversion, you pay the tax at your then prevailing marginal tax bracket on that converted value, but your distributions, your return of capital are all still being calculated on your pre-converted value. This is purely just tax arbitrage. So there's a huge tax incentive to take advantage of the discounted Roth, which our funds avail.
Yeah. So essentially, somebody brings tax deferred money to you to invest in the fund, and early in the life of the fund does a Roth conversion on that money,
Correct. And I
and
would encourage them to
they're
do it.
able to get a discounted, tax bill essentially on the Roth conversion.
Absolutely. And I would encourage Jim, to your point, to do it early, because once you're in years 3 to 4 and you start having return of principal, that will start to impair the discountability of the investment. So to your point, Jim, spot on. We would encourage clients to utilize the discount Roth in the first 1 to 2 years of the investment period.
Yeah. Okay, so somebody's sitting out there. They're like, I like this Eric Goodman guy. I want to invest some money. How? But I don't understand. How do I decide between the two funds? Who should invest in one? Who should invest in the other?
Yep. So great question, Jim. East End servicing is only ever open when LCSF 2 is closed. Fundamentally, we never want to have competing vehicles. We want to maintain always a difference and not have to worry about an alignment of which fund gets which deal. We want to avoid all conflicts of interest that we've done to date. And so East End servicing, to contextualize and consider its utility, is really there for two things. If LCSF2 is not yet available, or one of the rounds of LCSF2 is not yet open, let's say interim rounds from round 1 to 2 or so on and so forth, that's when East End Servicing will be available to accept capital investment. As soon as a round for LCSF2 is available, investors in East End will be able to roll over that capital into LCSF2, but we will not be closing any new deals in East End Servicing. So it's really just there, if you will, as a interim cash management vehicle. Now, it does provide quarterly liquidity at a slightly lower return of an 8% pref, which is paid monthly, can be utilized for DRIP. But for those who don't mind locking up capital for 2 years and want to get a net 10.5, with the ability to get up to 12% by utilizing DRIP, utilizing the QBI deduction, LCSF1 is really that target profile. Same credit risk, sub 50 LTVs, same types of assets, same type of market, just a higher return because of the 2-year tie-up. So you're really just getting a premium for the lack of liquidity for those 24 months. That's how you should contextualize the two. Again, between East End and don't be shy. East End is open. You can use it for a 2-week investment. A lot of clients don't want to earn 3% in the bank. They say, Eric, you're launching LCSF2 in 30 days. Park me in East End for 30 days. Do an internal transfer so I can optimize my investment. I don't want to earn 3% in the bank. And if you're earmarking capital for LCSF2 to earn a net 10.5 at a minimum, why earn 3% when you can earn 8% with an automatic rollover within that 1 week, 2 week, 3 week time frame in between rounds of LCSF2?
But I can't come to you and say, I just want to invest in East End. I just want to leave my money there for 5 or 10 years because I like having an evergreen fund. That's not an option.
So it's funny, Jim. We have not gotten that request too often. Ostensibly, most of our clients have been with us for years. So some of our clients have been with us for 10, 11 plus years. We've done many syndications. This will be our third discretionary income fund. And the way I've grown my business is we raise capital, we perform, we return the capital, we launch the next fund. And that's been thankfully, that's been the cadence of all of our funds to date. Now, East End Servicing, ostensibly, one could park capital in there. But I guess if you knew you were going to park capital for 5 years, I would say that you're better off earning another 200 to 250 bps spread, 2 to 2.5% spread, knowing that you're only locking up capital for 24 months and will start getting return of principal by year 3. So I would think of utilizing East End as a conduit vehicle to optimize capital while waiting to invest in LCSF2. Or if you know you're going to have a big tax bill next April and you don't have the time to invest for 2 years, you just want to park it for a certain number of months before paying Uncle Sam, those have been the two greatest forms of utility of East End servicing. But ostensibly, someone could park it for 5 years if they so wanted.
All right. Well, Eric, I think we've probably gone long enough tonight. Everybody, thank you for your time and attention. Those of you who are interested in learning more about investing with Goodman Capital, you can go to whitecoatinvestor.com/Goodman to get more information. And obviously, they'll pick up their phone and answer emails, et cetera, any other way you contact them. But that's probably the easiest way for white coat investors to remember how to get in touch with Goodman Capital. It's whitecoatinvestor.com/Goodman. Eric, thanks for your time and appreciate you coming on and doing this webinar with us.
Thank you so much for the time, Jim. Look forward to speaking with you soon.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.